Okay, so let me remind you what we said last time concerning this topic. We were looking at how a company would normally prepare their cash flow statement. And we had said, whenever a company is required to prepare a cash flow statement, they have to classify their cash flows. They have to classify their cash flows into 3 categories. 1, we said the cash flow from operating activities. 2, cash flows from investing activities. And 3, cash flows from financing activities. And we looked at how to determine the cash flows from each of the 3 categories. Like I can see here, we looked at how to determine the cash flow from operating activities, where we had said you start with what we were calling the profit before tax. Then we were saying you adjust it with all the non-cash items that your company would have incurred, all the non-cash items that went into the income statement or to the profit and loss, yet no cash was involved. We gave examples like depreciation, impairment, amortization, bad debts, provision for bad debts. Then I also gave you another example, loss on disposal, gain on disposal. You remember we said you minus, and finance cost. I do hope you remember we said in any question you have ever done or you will ever do, 2 of the non-cash items will never miss in any question. I hope you remember that. One of them we said is the depreciation charge. That is something one should not forget. It will never miss. We agreed last time that whatever is the depreciation charge for the year, some questions may give it to you, some other questions may not give it to you. It could be your responsibility to determine it. The second must find item in any question you will ever do or you have ever done is what we were calling the finance cost. Those 2, we said you have to remember. They will always be there in any question. And as far as finance cost is concerned, if you remember, I told you that is something you pick from the income statement. You don't have to calculate it. Whatever is the charge for the year for finance cost, I told you it's a figure you have to just pick, because the examiner will give you the income statement for the company, the income statement for that company. Once you're given the income statement for the company, we said you now pick the figure for finance cost. Good. Then we said once you adjust the profit before tax with the non-cash item. So I told you, if you remember, that when you are given this question, from that section alone, it's like you already have 3 marks for free. 1, we said you should always remember the profit before tax is something you pick from the income statement. That's given. Depreciation charge, you should remember, you should always get it there. You should find it. If not given, find it. Then finance cost, that is something you know. So those 3 things you should never miss. The others like impairment, amortization, bad debts, provision for bad debts, those ones we said you may find them in some questions, and in some questions you don't find them. Okay, good. So having reminded you that you have taken the profit before tax, you have adjusted it with all the non-cash items in the income statement, then we said you get what we were calling the cash flow before working capital changes. Then we said you incorporate in the working capital changes. These include current assets and current liability items. Okay, good. Then we said some of them could be increase or decrease in those current assets component, like increase in stocks, increase in debtors, increase in creditors, and so on. That's what we said. Then from there to Kasema, get the totals. Once you get the totals, we said you minus the tax paid. Once you minus the tax paid, we said whatever figure you get, that figure, take it to the extreme. That is what we were calling the cash flow before, the net cash inflow, the net cash inflow from operating activity. If it's a positive, we said if it's a negative, you would call it net cash outflow from operating activities. Then we came to the second class of cash flows, and that's what we were calling the cash flows from investing activities. And we said investing activities are those transactions that affect any fixed assets, or what you could call the non-current assets. We gave examples like purchase of fixed assets, sale of fixed assets. I also told you investments. If in your balance sheet you have investments among the fixed assets, then you could have either bought some investments or you could have sold investments. So any purchase of an investment which is under the fixed assets in the balance sheet, that is also considered as an investing activity. Then I told you that investment that you bought, if it gives you an income either in form of dividend, that dividend income or whatever is the investment income from your investments, that investment income we said should be classified as an investing activity. Good. Then after that, we assumed those are all from this illustration. We said you get the net of all those investing activities. Push it to the extreme. You can see there, we were assuming ours is a negative. And we said if it's a negative, then you call it net cash outflow. You call it net cash outflow from, investing activity. Otherwise, if it's a positive, you call it net cash inflow from investing activities. That's what we said. Then we said you go to the last class of activities, and that is financing activities. And we said these are transactions that affect finances of your company. We gave examples like issue of shares. When your company issues shares, of course, that's financing. They received money. Maybe your company issued some debentures, or they could have repaid part of the debentures. Then we said they could have issued, or they could have repaid their loan, or maybe they could have got some additional loan. Then I said, after you have identified the main financing items like issue of shares, issue of debentures, and maybe additional loan, whatever, we say the returns that you as a company pay to these financiers, the returns that you pay to them, that kind of a return is also classified as a financing activity, because you issued shares to finance your business. The return that you pay to the shareholders is what we call dividends. So we say dividend paid is considered as a financing activity. To the loan providers or to the debenture holders, you normally pay them a return called interest. So when you paid interest because you are borrowing, the cost of borrowing through debentures or through loan, that is what we call interest that you paid, and it's also classified as a financing activity. We gave those examples as part of financing activities. Good. Then we said again, get the totals of those financing activities, push the figure to the extreme. Whatever it is, ours we were assuming it's a positive, and if it's a positive, you remember we said you call it net cash inflow from financing activities. Net cash inflow from financing activities. Good. Then once you have identified the three categories of cash flows, we said you get the total of those three categories. Get the total of those three categories. That is the figure you got for operating, the figure you got for investing, and the figure you got for financing. Add all of them. Whatever you get down there, that we said could either be positive or negative. We said if it's a positive, we said you call it what? Increase in cash and cash equivalent. If it's a negative, we said you call it decrease in cash and cash equivalent. Then from there we said you now add what we called the opening cash and cash equivalent. And I told you in any question for cash flow, you will be given two balance sheets or two statements of financial position, one for last year and one for the current year. So to determine the opening cash and cash equivalent, we said you go to the balance sheet last year, whatever was the closing cash and cash equivalent last year, automatically that becomes the opening cash and cash equivalent. Once you add the opening cash and cash equivalent, then you get the total, and that total is what we said you call it the closing cash and cash equivalent. Good. So I think I've reminded you what we said concerning how to prepare a cash flow statement for a company, having those three categories: the operating, the investing, and the financing. Good. Then, before we continued, I can see here, I must have reminded you that if you are new to this group, you said you can tell your friends, or I can see we said you can tell your friends that we offer online classes. You can tell your friends we offer online classes for advanced financial reporting of the advanced level, financial reporting of the intermediate level, financial management of the intermediate level. I can see financial accounting of the foundation level, and the one of ATD1 and ATD2. So I must have told you that you tell your friends that we are offering online classes for those 4 subjects. Then I also told you that if you join the live class and you're not able to join to attend all the classes, we said you should not panic. You should be able to watch, or you can still be able to watch the video of the missed class. In case you miss a class, you just go back to the group where the link is, and you'll be able to watch the video of any class that you missed. Alternatively, we said if you're not able to join the live class, we said you can buy the pre-recorded videos. You can buy the pre-recorded videos whereby you can watch the videos at your own free time, at your own pace. Then we said whenever you have a question, you can call me anytime and I'll help you. From there, we said in case you need to reach me, well, you can see here we wrote our number 0722 658875. That was the number we said you can reach me with, 0722 658875. If we are using the country code, we said it's 254722. Then I can see I must have told you, for those who are watching through YouTube, I can see I must have told you, please click that subscription button to subscribe to our YouTube channel so that you can be notified whenever we post new videos into the YouTube. I told you the name of the YouTube channel I can see there is CPA Joseph Njuguna. I also told you, please click that like button to like the video. Click that like button for those who are watching through the YouTube. Click the like button to like the YouTube. Good. Then I can see, good. This is where we now stopped, and I must have mentioned this. So let me now continue. I must have mentioned this, that there are 2 methods of presenting a cash flow statement for a company. There are 2 methods of presenting a cash flow statement for a company. One method is called the indirect method, and the second method is what we were calling, or what we called, the direct method. And I told you the difference between the 2 methods is only on how you present the cash flows from operating activities. The only difference between the 2 methods is how you present the cash flows from operating activities. Otherwise, the investing activities and the financing activities don't change whichever the method you are following. Okay? Even if you are told to prepare using direct, you still use the same everything for investing activities and same everything for financing. The only difference is how you present the operating items. Good. Then I can see here, I must have introduced, and before I introduce that, I must have told you that the method we have just illustrated here, of presenting cash flow from operating activities, this is the method we were calling the indirect method. This is the method we were calling the indirect method. And it is the most commonly used method. Most students prefer this method of presenting the cash flow statement. That is the indirect method. But what I said, sometimes you may be required to prepare your cash flow statement using the direct method. And that's where we stopped, and that's where I want to continue now. That's where I want to continue. So we said, when you are required to determine the cash flow from operating activities using the direct method, then I told you, you only need 3 figures. I can see we wrote them down. One is what we were calling the cash received from customers. 2 is what we were calling cash paid to suppliers. 3 is what we were calling cash paid for services rendered. So for cash flow on this method, for cash flow from operating activities using the direct method, you only need those 3 figures. How much is the cash that as a business you receive from your customers? 2, how much is the cash that you as a business you paid to your suppliers? And 3, how much is the cash that you paid for all the services that were rendered to you as a company? The only issue we said was, when it comes to this direct method, the examiner will never give you any one of these figures. Normally, it is your responsibility to calculate these 3 figures. Once you calculate them, we said, get the total of all of them. Then you minus the tax paid. That's common in both methods. Tax paid. Then you get whatever you're getting, push it to the extreme. And that becomes your net cash inflow or net cash outflow, depending on whether it's a positive amount or it's a negative amount. Good. So what we were to discuss is, how do you determine each of these 3 figures? How do you determine each of these 3 figures? So let me go through on how you determine the cash received from customers. I told you last time, we are not talking of cash received from debtors as a company. We are talking of cash received from customers. Which kind of customers? All the customers you sold goods to on credit, how much did you collect from them? Plus, how much is the cash I received from all my customers to whom I sold goods on cash basis too? So we are looking for cash received from all our customers, whether they are credit customers or cash customers, all of them. How much did we receive from them? Good. Now, to determine the cash received from customers, we normally prepare an account of debtors. By now, you know how you used to prepare a debtors account. Like, of course, if I may say this, you did what you used to call debtors control. In your financial accounting, you did what you used to call debtors control account. Good. Now, so what you will do, the examiner for cash flow question will not give you the total cash received from customers. So what you will do, you will prepare a debtors account, or in other words, you can call it debtors control account. You will feed in, listen, you will feed in all the information concerning your customers in this account. The only missing thing that you don't know is the cash that you receive from your debtors or from your customers. But everything else you will be given. The only thing you don't know is the cash you received from customers. So let me remind you some of the key items that normally go to a debtors account. So you will prepare a debtors account. You will bring in the balance by the beginning of the year. From the balance sheet last year, go to the balance sheet last year, find out what was the closing debtors last year. Bring it down. It's an asset. Then, of course, you also know other things that go into a debtors account could be things like bad debts. You know, when a customer is written off as a bad debtor, we normally credit the debtors account. You will credit debtors account, whatever it is. You also know when a customer returns goods back into the business. When a customer returns goods back into the business, we normally call it return inwards. You credit. When a customer returns goods into the business, you normally reduce what the customer owes you by crediting his account. That is what you normally do. Another thing that normally goes to a debtors account is what we can call discount allowed. Discount allowed. When you as a business, you allow some customers some discount, you are actually reducing what they owe you. And therefore, you have to come and credit. Good. Now listen. Another thing that normally goes to a debtor's account, I'm only reminding you first the general thing that normally goes to a debtor's account is the cash you received. Cash received. When you receive cash from debtors, we normally debit bank and you credit debtors. Another thing that normally goes into a debtor's account, listen, another thing that normally goes into a debtor's account is credit sales. We normally debit the account of debtors with the amount of the credit sales. Listen, assuming that's all, you come and balance by calculating what we normally call balance carried down. That's how we normally prepare a debtor's account. That's how we normally prepare a debtor's account. But listen, I have said, as far as cash flow is concerned, the examiner does not want you to prepare a debtor's account and get the balance at the end of the year. No. What he will not give it to you is this figure we are saying is the cash received from debtors. That is a figure he will not give it to you. The cash received from debtors. Otherwise, he will give you all the other information from the question. He will give you all the other information from the question. The only thing you don't know is the cash received from customers. And therefore, that amount, we shall be getting it as a balancing. Listen, we shall be getting it as a balancing figure by feeding in all the information. You go to the balance sheet last year from the question, find out what was the closing debtors last year, becomes the opening there. 2, go through the additional information part of the question. Maybe there was a debtor who was written off as a bad debtor, you credit. Maybe from the question, you are told there was some goods that were returned back into the business by some of the debtors, you come and credit. Maybe you are told during the year there are some debtors who were allowed some discount. Of course, you know you have to reduce that amount, you credit. Then you go to the balance sheet, come the end of this year, you are given the balance sheet at the end of the year also. You know from that data, from the balance sheet, among the current assets you have debtors, come and enter it. Then, of course, the sales you will be given. So what I'm saying is this, you will be given all the other information. The only thing you don't know is the cash received. So to get the cash received, you prepare a debtor's control account, feed in everything, and then the balancing figure will become your cash received from customers. Point number two, listen. Point number 2, when you are preparing a debtor's account, we normally use this figure called credit sales. Listen, we normally use this figure called credits. To prepare a debtor's account, we normally use credit sales. Now, if we use credit sales for cash flow questions, listen, if we use credit sales for cash flow questions, then it means whatever we shall be getting here as cash received to be the balancing figure, that cash received as a balancing figure will represent, listen, will represent the cash that you received from only credit sales. I hope you are getting. I have said, whenever we prepare a debtor's account, then the rule is we normally debit debtor's account with credit sales. Not the cash sales. We normally debit debtors with credit sales, not cash sales. Therefore, I'm saying, if we use credit sales, then it means whatever you will get as a balancing figure in the control account, that balancing figure will represent only the cash that was received from credit sales or debtors. But we are not looking for, listen, we are not looking for cash received from credit sales only. We are looking for cash received from all the customers. Listen. So as far as cash flow questions are concerned, therefore, we shall not be using the credit sales alone to determine the cash received from customers. We shall not be using the credit sales alone. Instead, we shall be using the total sales. So that if you put in the total sales in the debit side, on the debit side of the debtors account, total sales will include both the credit sales and the cash sales. Listen, so if we use the total sales, then it means that when I'm getting the balancing figure in this account, that balancing figure will represent the cash that was received from both the credit customers and the cash customers. So, for cash flow questions, we are saying don't use only the credit sales. Instead, use the total sales. So that once you get the balancing figure we are discussing here, once you get this balancing figure, that balancing figure we are saying will now represent the cash received from all your customers as a balancing figure. That is the amount we shall be getting. So that's one key important point when it comes to cash flow questions. That when you're determining the cash received from customers, though I have said you prepare a debtors account, fine. It would have implied then I use the credit sales, then I use the credit sales. But I've also told you by using the credit sales, it means I'll only get the cash received from credit customers. But I want to determine the cash received from customers, not credit, not debtors, from customers, all our customers. And therefore we have concluded by saying you now use the total sales. Go to the income statement for that company. Whatever they are giving you as the total sales, you pick it. That's the important point when it comes to determination of the cash received from customers. That you don't forget and use the credit sales. You use the total sales. So that once you get the balancing figure in that account, that balancing figure which we are calling the cash received will represent the cash received from customers. Are you there? Good. That's all I can say on how we normally determine that amount I've called the cash received from customers. Okay? Good. Let me also talk about how do we determine the cash paid to suppliers. Cash paid to suppliers. So let me discuss the second one first before we put down a summary note or how to get it. So let me discuss them first again. Now, to determine the cash paid to suppliers, we shall be preparing again a creditor's account. I have said a short while ago, we are not determining cash paid to creditors. We are determining cash paid to suppliers. Which kind of suppliers? Those suppliers that supplied goods to us on credit. How much did we pay them? Plus the cash we paid to the suppliers who supplied goods to us on cash basis. Good. So again, we shall prepare creditors account, feed in all the information concerning creditors, and the balancing figure will represent the cash paid to suppliers. You will feed in all the information concerning creditors or suppliers. Feed in all the information concerning suppliers, and the balancing figure will be the cash paid to suppliers. Good. So where do you get the information from? Go to the balance sheet last year. Among the current liabilities, find out how much was the creditors. Bring it down on the credit side. Creditors are liability, whatever it is. Go through the question. Find out how much or whether there were things like return outwards. You all know if there are any return outwards, they are normally debited in the creditor's account. I'm only reminding you what you used to do when you are preparing a creditor's control account. The other thing that could go to creditor's account are good things like discount received. When there's a discount received, you reduce what you owe your suppliers by debiting. Any discount received, you normally debit. Listen. Then we know that we normally credit creditors with credit purchases. With credit purchases. Whenever we purchase goods on credit, we normally credit creditors with credit purchases. Now listen. Then, whenever we pay our suppliers, when we are paying our creditors, we normally debit cash paid in the creditors account, whatever it is. Then by the end of the year, we normally get the balance carried down. So I've just first reminded you how we prepare a creditors control account. You bring down the balance by the beginning. If there was any credit purchases, you credit. If there was any return outwards, you debit. If there was any discount received, you debit. Whatever is the cash you pay to your creditors, you debit. Then you carry down the balance by the end of the year. That is the normal creditors account. But now we are using it for purpose. We want to use it for purpose of determining cash paid to suppliers. One thing, as far as cash flow is concerned, the examiner will not give you the cash paid to creditors. He will not give it to you. That's one. Two, you will have to get it as a balancing figure. Now, point 3. If I use again, listen, if I use credit purchases on the credit side, it would mean that what I'm going to get as a balancing figure in the control account will represent only the cash I paid to my credit purchases or those credit suppliers. But I'm not looking for the cash I paid to the credit suppliers. No, I'm looking for cash paid to all our suppliers, both those who supplied goods to us on cash basis and those who supplied to us goods on credit. How much is it that we paid to them? So just like debtors, listen to this now, just like debtors, again, we do not use the credit purchases. Instead, we use the total purchases. We use the total purchases here to determine the cash paid to suppliers, not creditors. To determine the cash paid to suppliers, we use the total purchases on the credit. So get the total purchases of the company and you use them, not credit purchases. So that once I do that and I've put in everything else for cash flow, I've gone to the balance sheet last year, I've picked the creditors last year, gone to the question, found out what is the total purchases of the company, gone through the question, maybe there was any return outwards, I've entered, or maybe the question tells me about discount received, I've entered. Then I'm assuming that's all. Then I've gone to the balance sheet come the end of this year. I've seen that there is a balance. We carry down whatever was the creditors by the end of the year. I come and say your balance carried down by the end of the year from the balance sheet this year. Once I do that, there will be a missing figure or there will be a balancing figure in this account. And that balancing figure is now what we are calling the cash paid to suppliers, and that will become the balancing figure. That will become the balancing figure that we shall be calling the cash paid to suppliers. So that's how we shall be determining the cash paid to suppliers as a balancing figure in the creditors control account or in the creditors account. Good. That's how we do it. So the most important thing again here is to remember that we use the total purchases, not only credit purchases. Because if you use credit purchases, you will get the cash paid to credit suppliers. But I've told you, we are trying to determine the cash paid to all our suppliers, Good. So before we go to the last one, before we go to the last amount, which is the cash paid for services rendered, I think we can now put down that. We can now put down what we have already said. So what I can't remember, you will remind me for those who are there last week or last time. Did we put down the summary note on the format of the direct? Did we put down the format of the direct? method. Did we show this section, the upper section, this one, as part of the notes? For those who were with us last time, I remember I only mentioned, but I don't know whether we had put down the summary note. Okay, Sylvia says no. Sylvia says no. So let's now put it down. So andika another subheading. Andika another subheading. Andika another subheading. Cash flow statement using direct method. 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 That is the subtopic. Cash flow statement using direct method. Cash flow statement using direct method. Then you can copy this. We come and say your cash flow. Cash flow from operating activities. Cash flow from operating activities. Cash flows from operating activities. Cash flow from operating activities. Then you come and say, yeah, cash received from customers. Cash received from customers. Cash received from customers. Whatever it is, that's a positive. Then you come and say your cash paid to suppliers. Cash paid to suppliers. Whatever it is, you minus. Then you come and say your cash paid for services rendered. 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 Whatever it is, then you can show like you're getting the totals. Then you come and say your tax paid. Tax paid, whatever it is. Then you get the net, push it to the extreme. And that's what we are calling cash flow. Net cash inflow. Net cash inflow from operating activities. 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 So I hope you are through with the copying, so that now we discuss each of them. We are through. Want to discuss how to determine each of them. Okay, if you are through, I hope you are through with the copying. You can write down there to determine. You can write down there to determine the cash received from customers. To determine the cash received from customers, we prepare a debtors account. To determine the cash received from customers, we prepare a debtors account. To determine the cash received from customers, we prepare a debtors account. To determine the cash received from customers, we prepare a debtors account. Let's put it down now. Let's open that debtors account. I've told you, go to the balance sheet last year, bring down the balance. That's the opening balance. I've told you, come and debit this account with the total sales. Not only credit sales, but with the total sales. Then I've said, if there is any discount allowed, you credit. If there is any return inwards, you credit. If there is any bad debts, you credit. Then I said, go to the balance sheet at the end of the year, get the balance carried down, whatever it is. Once you do that, I told you there will be a balancing figure in this account, and the balancing figure now will be what we are calling cash received. As a balancing figure, whatever it is, cash received. That's how we shall be determining the cash received from customers. Finish. We also now put down the second one. Finish copying the cash determination of cash received from customers. Okay. If you are through, I hope you are through. You can put down another paragraph. To determine the cash paid to suppliers. We prepare a creditor's account. Determine the cash paid to suppliers. We prepare a creditor's account. Let's do it. So let's open a creditor's account. Again, we want to feed in all the information concerning creditors, or in other words, suppliers. We go to the balance sheet at the end of last year, find out what was the closing balance last year. That becomes the opening balance this year. Then I've also said, pick the total purchases, not only credit purchases, total purchases. Mark you, that's important. Whatever is the total purchases. Then I've also said, if there is any discount received, you debit. If there is any return outwards, you debit. Then I said you carry down the balance by the end of the year, whatever it is. Then there will be a balancing figure in this account. That is what we are calling the cash paid, as a balancing figure now. That's how we shall be determining the cash paid to suppliers. Finish. We want to go to the third item. Finish. We want to go to the third item. Okay, so allow me to introduce how to determine the cash paid to suppliers. Allow me to introduce how we determine the cash paid to suppliers. As for services rendered, sorry. We want to discuss now how do we determine the cash paid for services rendered. Now listen, that is the most critical. I want you to be attentive because that's the most critical working. Of the three figures, the third one is the most critical one and more involving. So allow me to introduce that section by giving an illustration. In any question, listen, in any question for cash flow question, the examiner will give you the income statement for that business. But in the income statement, you will be given like sales, whatever the figure. Let me assume you are given an income statement. You're given the cost of sales. Don't write yet. You normally get the gross profit. Then we normally come to expenses like the admin expenses. Whatever it is, you normally come to what we call distribution expenses. Whatever it is, you normally get what we call profit from operations. From operations. Then from there, you normally come and charge what we call finance cost. Whatever it is, then you normally get what we call profit before tax. That's the income statement that your company has given to you. Listen, we want to determine how much is the cash paid for services rendered. Last time I told you what kind of services have the company been given. You have to, and you paid for them, and you paid for those services. I told you, for example, employees gave you a service, you must have paid them salaries. The landlord gave you a service, you must have paid them rent. Kenya Power gave you a service, you must have paid them for electricity. So in other words, we are looking for, listen to this now, in other words, you are looking for, what is it that you paid for all your expenses? For all your expenses. I'm rubbing somewhere, watch. Suppose from your question, the admin expenses of this company were 100 million, while the distribution expenses were 50 million. Listen, so it means that you as a company, you charged the income statement with the total expenses amounting to 150 million. 100 million for admin expenses and 50 million for distribution expenses. But the question is this, listen, did we pay 150 million for all our expenses? The answer is no. You could have even paid more than 150 in cash, or you could have paid less than 150. But remember, we normally prepare our income statement, or we normally prepare our financial statements on a concept we call accrual concept or accrual basis. So it is obvious, therefore, that you may not have paid all that 150 amount that you charged in the income statement. So in actual sense, how much is it that you paid for expenses in cash? Another thing is this, among those expenses, whether admin or distribution, among them, There are some of them that you never paid any cash for them. They are what we can call non-cash items, like depreciation. Obvious, when you depreciated your delivery van as a company, you included that depreciation charge among the selling and distribution expenses. When you paid for the rent of the office, you included among the admin expenses. When you depreciated your office equipment, you included it among the admin expenses. But when you charge the depreciation of the office equipment, did you pay for that depreciation? No. So we are saying, as much as it's true you charged 150 in the income statement for the services, we actually never paid 150. How much is the true amount that we paid? That's what I want to talk about now. That's what I'm saying is a bit involving. So allow me now to introduce how we normally determine the cash paid for services rendered. To determine the cash paid for services rendered, we shall be opening an account called expenses. Again, listen, you feed in all the information concerning expenses as far as the question will allow you. The only thing the examiner will not give you is the actual cash we paid for expenses. And that's what we want to determine. It's true, we charged 150 for admin and distribution, but did we pay 150? No. Now listen. So to determine the cash paid for services rendered, I have said we prepare an expense account. Go to the balance sheet last year. Find out, were there any accrued expenses last year? Were there any prepaid expenses last year? If there were any accruals or owing last year, bring it down. You come and say, yeah, owing brought down. It's a liability. From the balance sheet last year, because the examiner will give you another balance sheet for last year, find out among the current assets, could be there was prepaid electricity, prepaid rent. It's an asset, bring it down. You come and say, yeah, prepaid, brought down. Whatever it is. Listen to this now. Once you bring down the opening balances, either as a prepayment or as an accrual, whichever it is, listen, now go to the income statement and pick the charge. Listen, and pick the charge for the year for expenses. One is admin, 100 million. Two, distribution, 50 million. Listen. Those two charges have been debited. Listen, they have been debited in the profit and loss account. When it comes to your expense account, you will have to credit them, not debit. You will have to credit them. Remember, listen, remember, P&L account is part of double entry. P&L account is part of double entry. So having debited P&L account with 100 million for admin expenses, you obviously never debited expense account with 100 million. No. That 100 million is the charge for the year. It must have been credited in the expense account. So you come and say, yeah, admin expenses. How much? 100 million, whatever it is. The other amount is the distribution expenses. We have charged P&L account with 50. Meaning you have debited P&L account with 50 million. It must have been credited in the distribution, in the expenses account. That distribution expense, 50 million. Then, now listen. You ask yourself this question. Yes, I have credited this expense account with 100 million for admin expenses. Is there anything within that 100 million where I paid no cash for it? Yet, I included it as an expense under admin. It is possible. I've said, among the admin expenses, Yes, you charge 100 million, but among them, there could be a non-cash item that you classified as an admin expense. But we are not looking for how much we charged for admin. We are looking for what we paid for admin expenses. So if among these 100 million, there is a non-cash item within that 100 million, which I never paid cash for it, then I knock it off against the 100 million. One example I've already mentioned is, for example, depreciation of office equipment. When I depreciated my office equipment, I included that depreciation as an expense called admin expense. But is it something that I paid for it? The answer is no. How do I remove it from there? I come and debit whatever is the depreciation charge. Remove it. Same, maybe among the selling and distribution expenses, I could have depreciated my delivery van. When you depreciate your delivery van, you normally classify that depreciation as a selling and distribution expense. But is it true that you paid for that for that depreciation? No. So if I want to know how much I paid for distribution expenses in cash, then I have to remove from there anything that is non-cash, which I'm giving an example, depreciation of delivery van. Now, I want you to tell me, what are some other expenses that your company could have incurred and either included them as an admin expense or included it as a selling and distribution expense, yet no cash was paid for them? Tell me some other expenses that your company could have charged in the income statement, either under admin or selling and distribution, yet no cash was paid for them, so that we remove them from that charge, so that once I get the balancing figure now, it will only remain purely what we paid. So give me a few examples. Give me a non-cash expense that could have been included as an admin expense or as a selling and distribution expense. I'm waiting now. There are too many examples of non-cash expenses which could have been included either as an admin expense or as a selling and distribution expense. Which kind of provision? Let me assume for you. James is giving me provisions. I want to assume for him, because even depreciation is a provision. So I don't know which specific provision you wanted to give, James, because even depreciation is a provision. We normally say provision for depreciation. So I don't know which provision you meant. Maybe you can, good, thank you. Provision for bad debts, good. That's true. Listen now, whenever as a company you anticipate that some of your debtors are likely not to pay you, you normally make a provision. When you anticipate that some of your debtors are likely not to pay you, the rule of accounting says, that is prudency concept, says you are required to provide for that bad debt. Provide, make a provision, provide for the loss. So you as a company, when you anticipated that some of your debtors are likely not to pay you, you made a provision. Obviously, you must have included it among the selling and distribution expense. Good. So you came, now say here, provision for bad debts. Remove it. Provision for bad debts. Let me give you another one still on that. Even, listen, even the bad debts themselves, not provisions, the amount written off. When a debtor becomes a bad debtor, you have to write him off. Okay? When you wrote him off, you must have debited an account called bad debts and you must have credited data. Then come the end of the year, you close the account called bad debts account to the P&L account. And of course, you must have included it as a selling and distribution expense. It came because of selling. So even bad debts, not only provisions for bad debts, even the bad debts themselves are classified as non-cash items, and you charge them among the selling and distribution, therefore come and remove them. Give me another expense. I am not saying that it must go to the admin or distribution. Just give me an expense, because in the exam, the income statement you have could be given. They may not call it admin expenses. They may not call it selling and distribution. They may just call them operating expenses in the income statement, and they charge 150 million. So I'm not specifically saying that the examiner will call it admin, the examiner will call it selling and distribution. No. It depends with the question. Some questions may call it selling and distribution. Others may call it operating expenses. Good. Somebody has given me another one. Thank you, Kirui. You have said impairment. Good. When you impaired an asset called goodwill, you never paid for that amount or that loss. That's an non-cash item. Good. So another one is impairment. You remove it. You must have put it among the admin expenses. So any impairment loss is an non-cash item. Good. Let's move on. Now give me another one. We are getting it now. We are getting it now. I am only asking you, tell me of expenses that normally go to the income statement, which are non-cash items. I'm not saying classified as admin or classified as, no, just any expense that normally goes to the income statement, yet no cash was paid for it. Yes, there are too many. There are too many. Yes. Stella has given me amortization, correct? When you amortized your intangible assets, of course you must have classified it as an admin. Come and remove it. Amortization is an non-cash item. Good. Somebody has given me loss on disposal. Loss on disposal. Let me explain. Now, listen. I want to leave. Listen carefully here. I want to leave that discussion of the loss on disposal for now. Reason being, as much as it is true, it's an non-cash item. Listen, there are times we use it in this account, and there are times we don't use it in this account. I'm saying, I'm agreeing with who? Hirui, that yes, another non-cash item is loss on disposal. True. But when it comes to cash flow questions, and you are determining the cash paid for services rendered, that loss on disposal, there are times you use it in this account, there are times you don't use it in this account, depending on how the examiner has presented the question to you. Depending on how the examiner has presented the question to you. For the others, like depreciation, provision for bad debts, impairment, bad debts themselves, amortization, have no problem. But when it comes to loss on disposal, you must be very careful. So for now, listen, let me assume that we are not using it for now. I'm assuming then also that you have done everything from the question. You have gone to the income statement, a balance sheet, you brought down the owing, you have gone to the balance sheet, you have brought down the prepayment. Then I have said, you have gone to the income statement the examiner has given you, and you have picked the amount of the charge for the year for expenses by whatever name the examiner is calling it. Whether he's calling it admin, whether he's calling it distribution, whether he's calling it operating expenses in the income statement, pick it. I have told you that amount is normally debited in the income statement. It's normally deducted. When an amount is deducted in the income statement, it means you are debiting. So that amount being debited in the income statement, it has to be credited in the expense account, because P&L account is part of double entry. You cannot debit P&L account and then debit expenses with the same amount. No. The rule of double entry is followed. So once you pick the charge for the year in the income statement, then you come and credit. Ours, we were assuming admin and distribution. I've said it could be operating expenses. Then from there, listen, go through the question and ask yourself, in this charge for the year, by whatever name they are calling it, what are some of the non-cash items included there? Once you know them, remove them from the charges. We have given example like depreciation, provision for bad debts themselves, amortization, and impairment. Once you do that, go now to the balance sheet at the end of this year. From the balance sheet this year, find out whether there are any accruals and prepayments. If there are any accruals, you will know accruals are liability. Listen, they are liabilities. And the liability by the end of the year, you first carry it down from the opposite side. You come and say, owing, carry down. Whatever it is. Remember, it's a liability. A liability is always a credit balance. Listen, you cannot have a credit balance as a brought down without a carry down. That's why we are carrying it down by the end of this year. By the beginning, I just brought them down. Why? Because they were carried down last year. But come the end of this year, a liability being a credit balance, you must carry down first on the opposite side. Then, go through the same balance sheet, see whether there were any prepayments. If there was any prepaid expense like electricity, water, and so on, it's an asset. An asset is always a debit balance. So, you come and credit, you say you're prepaid, carried down, not brought down, carried down. So that once you close this account, it will be brought down on the debit side as an asset. And the owing you carry down will be brought down on the credit side as a liability. Listen now, once you do this, there will now be a balancing figure. I'm assuming you have fed in everything in the account. Once you do this, now there will be a balancing figure in this account. That balancing figure will now represent the cash paid. It will now represent the cash paid as a balancing figure to represent the cash paid for services rendered. So this is generally how we normally determine the cash paid for services rendered. I've said you prepare an expense account, feed in all the information concerning expenses. There will be a balancing figure. That balancing figure will represent the cash paid for services rendered. I've also said what most students forget is how to enter the opening and the closing balances. For the opening, normally there are no problems. If it's a liability, just bring it down on the credit. If it's a prepayment by the beginning, just bring it down on the debit. What about the closing balances? It's that which I'm mentioning and saying, if it's an asset by the end of the year, we know assets are always a debit balance as a brought down. A debit balance as a brought down. But you cannot have a brought down without a carry down. That's why we are carrying it down on the credit side. So that once it is brought down, like now you say here prepaid brought down, it will now appear as an asset. Then if by the end of the year you have an accrual, an owing, then it's a liability. A liability is always a credit balance. But you cannot have a brought down on the credit side at the end of the year without a carry down. That's why we are saying you first carry it down. So that once it is brought down on this side, it will be reflected as a liability. That's important about how to enter the closing balances. Then the other issues I've said, any expense in the charge for the year which is non-cash, remove it. Now, I left one of them, one non-cash item. I left one of the non-cash items, which is what Kirui gave us, loss on disposal. And I want now to illustrate, when do we use loss on disposal in the expense account and when don't we use it? There are times when you may be required to use it in some questions. There are times when you may not be required to use it in some questions. So when do you use it and when don't you use it? Let me explain now. Now, I want to explain this. Sorry, just a minute. I want to explain this using an illustration. I want to explain when do we use them and when don't we use them using an illustration. Now listen. One company has two accountants. One company has two accountants. Accountant number A and accountant number B. Both of them were given the records of the company. Both accountants were given the records of the company and they were told to prepare the income statement for the company. One of the accountants, let's call him accountant A, prepared the income statement this way: sales, cost of sales. That person got the GP, kuja akasema admin expenses, whatever it is. He came and said distribution expenses, whatever it is. Akapata what we are calling profit from operations. Profit from operations. Akapata something like 300 million. That was accountant A. Accountant B prepared the income statement this way: sales, whatever it is, cost of sales, whatever it is. Akapata gross profit. Then akakuja akasema gain on disposal. Gain on disposal. He added maybe 5 million. Got whatever it is. Akakuja akasema admin expenses, whatever it is. Kuja akasema distribution expenses, whatever it is. Then akakuja akasema loss. This is accountant B. Akakuja akasema loss on disposal, maybe 10 million. Akakuja akapata profit from operations, 300 million. Now listen. Both of these two accountants have got the same profit from operations. Have used the same record. They have got the same profit from operations. But when I look at accountant A, I can't see the gain on disposal for him. When I look at accountant A, I can't see loss on disposal for him. Accountant B has shown me the loss on disposal, gain on disposal. So it is obvious this company must have sold an asset somewhere and they made a loss on disposal, 10 million. They must have sold another asset, they made a gain of 10 million. Gain on disposal of 5 million, sorry. But accountant A is not showing me. So it tells me that accountant A must have used the loss on disposal somewhere, must have used the gain on disposal somewhere. So when I'm doing for the cash flow, listen, when I'm doing the cash flow of accountant A, and I'm now determining the cash paid for services rendered, I will open the expense account for him. I'll put in everything in that account, admin, whatever it is that I'm given in their income statement. Distribution, I go and pick whatever they are giving me in their income statement. Then I remove depreciation. I remove amortization. I remove the bad debts and others. My question to you is this. You will be told somewhere, the company sold a motor vehicle and made a loss on disposal of 10 million. Tell me this. For accountant A, or let me put it this way. Let's now discuss, before I ask you that question, let's discuss for accountant B first. Accountant B also, I want to determine for him cash paid for services rendered. I also prepared for him the expense account. Went to the income statement, brought his admin expenses, whatever he has given us, brought down the distribution, got the depreciation charge for him, whatever he has given, got the amortization for him, whatever he has given, the bad debts. Now my question is, from the question I realized, they sold a motor vehicle and made a loss on disposal of 10 million. Question to you is this. When I'm determining the cash paid for services rendered, which of these two expenses account will I show the 10 million? Which of these two expenses account will I show the 10 million? In other words, you will not use the 10 million in both accounts for accountant A and B. I want you to look at the two income statements, the way they are presented. Then tell me, as much as it's true, the loss on disposal is an uncash item. In one of these two accountants, I'm not going to use their 10 million in the determination of the cash paid for services rendered. In one of them, I'm going to use the 10 million in the expense account. Question. Let me change my question. Which among these two expenses account will I not use? Will I not use the 10 million? The company must have sold an asset. It's obvious. Because they were using the same records, same everything. So accountant A must have used the 10 million somewhere. Accountant B has shown me the 10 million. But when I'm preparing the account called expenses for me to determine the cash paid for service rendered, which among these two expenses will I not use the 10 million? Is it accountant A or B? Somebody help me now. Where will I not use the 10 million? Is it in the expense account of accountant A or is it in the expense account of accountant B? Which among these two expenses will I not use the 10 million? Two people have said B. I don't know. Moses says B. Okay. Good. They are correct. Let me explain. Now, don't forget, listen, don't forget, we are trying to determine the cash paid for services rendered. For services rendered. Which services? These expenses here. The admin and the distribution. So for accountant B, I went to the income statement, picked those two expenses, the admin and the distribution, I brought them down there. Then I asked myself, listen, among those expenses, is there any non-cash item? Yes. Depreciation could be among the admin, remove it. Amortization, it's among the admin, remove it. Bad debts is among the selling and distribution, remove it. Listen. Then I realized this company sold a motor vehicle and made a loss of 10 million. I will ask myself this question. Listen, is it affecting what I am looking for? I am looking for the cash paid for the services rendered. Which services? The admin and the distribution. So I will ask myself, this 10 million, as much as it's a non-cash item, is it affecting what I am looking for? The answer is no. It's not affecting. Why? Because I'm looking for the cash paid for these two services rendered. But accountant number B has shown the amount 10 million separately. So it's obviously not affecting the figures I'm trying to adjust. So for accountant B, I'm not going to show the 10 million in the expense account. Reason being, it's not affecting what I'm adjusting. But when I look at the income statement of accountant A, listen, when I look at the income statement of accountant A, I can see they are not showing me 10 million separately. So it is obvious when they sold that motor vehicle or that office equipment and they made a loss of 10 million, they must have included it somewhere. And if they sold an office equipment, they must have included it among the admin. Or if they sold a motor vehicle, they must have included it in the selling and distribution expense. So it is obvious it is within the amount I'm trying to adjust. So for that loss of 10 million for accountant A, it's among the items I'm adjusting. So I'll be required to remove it. So in the expense account of accountant A, I'll come and now say here loss on disposal. Hope you are following. Loss on disposal of 10 million. So for accountant A, I have to use it. Why? Because the 10 million loss on disposal is affecting what I'm adjusting. While for accountant B, the 10 million loss on disposal, as much as it's true, it's an uncash item, it's not affecting what I'm adjusting. It's not affecting what I am adjusting. So I don't use it. Good. Let's go back. Listen to this now. There was also a gain on disposal. The company sold an asset somewhere. Our company sold an asset somewhere. This asset maybe had a book value of 10 million. We sold it for 15 million. We made a gain of 5 million. That gain is an uncash item. It's obvious. That gain is an uncash item. So the question is, will I use it? For accountant number A, I can't see it. For accountant number B, I can see that he has shown me the amount separately. So for accountant B, I'll ask myself, as much as it's a non-cash item, is it affecting accountant B? Is it affecting what I am adjusting? The answer is no. Why? It's not affecting the admin expense. It's not affecting the distribution expense. So it's not affecting the two. So I don't use it for accountant B. But let me ask you, this accountant A, where do you think he must have used the 5 million? He is not showing us. Yet the two accountants got the same profit from operations, 300 million each. So where do you think accountant A must have used the 5 million? Somebody suggest. Where do you think accountant A must have used the 5 million gain on disposal? Where did he include it? Somebody to suggest. Where do you think accountant A included the 5 million gain on disposal? Where do you think accountant A included his 5 million? We can't see it. So he must have used it somewhere. Where did he use it? We sold a motor vehicle or we sold an office equipment and we made a gain on disposal. Where did accountant A include it? Somebody give me a suggestion. Where do you think accountant A included the 5 million? Where do you think accountant A included the 5 million? I'm waiting for your suggestion. Yes. Where do you think accountant A included the 5 million? Hey, somebody to suggest. Where do you think accountant A included the 5 million? Somebody to suggest. I'm waiting for a suggestion, please. Hey. Where do you think? Excluded, and they got the same profit. It cannot be that he excluded it and they got the same profit. They must have used it. He must have used it somewhere. So James says he excluded. The answer is no. Billy says on the sales, no. Remember, sales are results from the goods you sold. Okay, let me explain. Now, I want to assume that we sold a motor vehicle and we made a gain of 5 million. So this is what accountant A must have done. Listen, when accountant A was trying to determine the expenses called distribution expense somewhere as a working, he must have taken things like provision for bad debts. He must have taken expenses like advertising, salesman's salary, all those expenses that he thought are of selling and distribution in nature. Okay? Then, when he was adding all of them, he realized that we sold a motor vehicle which is used for distribution and we made a profit of 5 million. What do I do? Listen, this accountant A must have decided that 5 million, he will net it against the other expenses for selling and distribution. So he must have come and said the gain on disposal, 5 million. Then whatever he got here, let us assume he got 50 million. That 50 million is what he took to the income statement here. 50 million as selling and distribution. If we sold a motor vehicle, an office equipment, then it means relating to admin. When this accountant A was adding the expenses relating to admin expenses, maybe depreciation of office equipment, salary to the office workers, electricity of the office, and many others, he realized, but we sold an office equipment which is used for administration and we made a gain of 5 million. What he must have done, he must have netted it against the admin expenses. He must have netted it against the admin expenses. So that's where the 5 million could have been used. If it's a selling and distribution item, that accountant A must have netted it against the selling and distribution. He got this 50 being the net after deducting the loss, the gain on disposal. That 50 is what he took to the income statement. That 50 is what I brought in his expense account here, 50. Listen. But the question is this: was that 50 the true expenses relating to selling and distribution? The answer is no. Why? Because he netted a 5 million against it, against the selling and distribution. So the true selling and distribution expenses must have been how much? 55 million originally. Before netting it against the 5 million, before netting the 5 million against the expenses, the original selling and distribution expenses must have been 55. Then he realized that we have an office equipment. No, we have a selling and we have a distribution motor vehicle which we sold, made a gain of 5 million. So he came and decided to net it. He remained with the 50, and that's what he took to the income statement. But the true selling and distribution expenses were not 50, they were 55 million. So what he took to the income statement is less. Listen, what he took to the income statement is less than it should be. That 50 which is less than it should be, I brought it to the expense account. But the true selling and distribution expenses were 55 million. So to correct that, we shall be crediting this expense account with the gain on disposal. With the gain on disposal. 5 million. I hope you have understood. There are key issues we have mentioned. Let me review what we have said before we put it down now as a summary note. We have said, to determine the cash paid for services rendered, what do? You prepare an expense account. Then I've said, feed in all the information concerning what? Expenses. How do you feed in that? Go to the balance sheet last year. You said you bring down the beginning balances, either as an owing or as a prepayment. Owing, just bring it down on the credit side at the beginning. Prepayment, bring it down on the debit side as a brought down. Why I told you? Because they were carried down last year, so we just bring them down by the beginning of this year. Then I said, go to the income statement that the examiner has given to you. Pick the charge for the year for expenses. I've told you, those charges are normally debited in the P&L account, so you credit the expense account here. Good. Which was in my illustration here, admin 100, selling and distribution 50. Then I've said, ask yourself from the question, what are the non-cash items out of the admin and the distribution? If there are any as per the question, remove them. We have given examples like depreciation, provision for bad debts themselves, impairment, amortization. Having done that, now listen, having done that, now you realize, listen, now you realize, oh, there's a loss on disposal the company made. That loss on disposal is what I'm insisting by saying, the times you use it, the times you don't use it in this account. I've said, we use it in this account if it is not shown separately. If it is not shown separately, like accountant A. Otherwise, if the loss on disposal is shown separately, like accountant B, then don't use it. Why? Because I said it's not affecting what I'm looking for. For accountant A, the loss on disposal was affecting because it was included among the items I'm trying to adjust. So in that case, for accountant A, I come and use it. So I'll come and say here, loss on disposal. For accountant A. For accountant B, I'm not going to use it. Why? Because it's not affecting what I'm looking for. Another thing I've said, if there's a gain on disposal, as much as it's true, it's an non-cash item. Whether you are using it or not, again depends. Again depends on whether it is shown separately or not shown separately. For accountant B, I said, don't use it. Why? Because it was shown separately in the income statement. But for accountant A, that gain on disposal is not shown. What do you conclude? It must have been netted. Listen, it must have been netted among the expenses. It must have been netted against the expenses. By netting it against the expenses, it made the expenses less than they should be. To correct them, you come and add that gain on disposal. whatever it is. We use them when they are not shown separately, like in the accountant A. We don't use them when they are shown separately, like accountant B. Some of your past papers are given a case of accountant A. Some of your past papers you are given a case of accountant B. So if you are told to use the direct or indirect method, that's not a big deal, because we are not preparing an expense account in the indirect method. So for indirect method, you will use them in either way, like we did last time. But when it's a direct method question, gain or loss on disposal, whether you're using it depends on how the question is given. So this is only when the examiner is asking you to use the direct method. Otherwise, for indirect method, it doesn't matter. They are somewhere affecting the profit. Remember, listen, for indirect method, we were adjusting the profit before tax. Whether they have used them separately or not shown them separately, it's affecting the profit before tax. So for indirect method, the first one I started with here, when we were discussing the format, I had to use the gain or loss on disposal here. Why? Because it was affecting the profit before tax that we were adjusting up here. Hope you are getting my point there. For indirect method, we were not adjusting the admin and the distribution. We were adjusting the profit before tax. So whether they netted it against sales, against admin, or they never netted it, or they have shown it separately, it still affected the profit before tax. So for indirect method, the gain or loss on disposal have to be used anyway. But when it comes to direct method, we are not adjusting the profit before tax. We are adjusting the charge for the year for expenses by whatever name they are calling it, either admin or distribution. Therefore, I've said for direct method, whether you're using the selling, whether you're using the gain or loss on disposal, depends on how the examiner has presented the income statement. I've said if it's shown separately, like it was shown in the accountant's B case, don't use them. In the which account? In the expense account. If they are shown separately, if they are not shown separately, like accountant A, then you have to use them. Good. Let's put down that summary note. Let's put down that summary note now. Andika somewhere. To determine the cash paid for services rendered, we prepare an expense account. We prepare an expense account as follows. To determine the cash paid for services rendered, we prepare an expense account as follows. I don't have to rub anything, just copy this. I don't have to rub anything, just copy that. Just copy that. So copy that expense account. Then we shall put down a note. You bring down the balances by the beginning, either as a prepaid expense or an accrued expense. Then I said on the credit side, you pick the charge for the year for expenses as admin and distribution. Copy that. Okay. Then, of course, you can now copy what is on the debit. From the charges for the year, in terms of admin and distribution, we are removing the non-cash items, depreciation, provision for bad debts, impairment, amortization, loss on disposal. copy all the items there. Then I want to put a small NB note. Okay, if you are through, somebody can write down. So that, let me roll the question. Let me roll. You don't have to write this below once. No. So copy that. We want to write an NB. Remember, for cash paid, you put in bracket balancing figure because that's what you are not given. That's what we are determining as a balancing figure. Whoever is through can write down that I move on. Whoever is through, or if you are through, you can chat and say done, that I know you are through with the copying. Thank you. Okay, thank you. At least most people have finished. Now, we want to put down a small NB because of that gain or loss on disposal. So, andika below that, NB, if you are through with the copying. Andika somewhere below the account, NB. If you are through with the copying, you can write NB. Then you say this. We use the gain or loss on disposal. We use the gain or loss on disposal in the expense account. We use the gain or loss on disposal in the expense account if, or you can even add only if, we use the gain or loss on disposal in the expense account only if they are not shown separately. Only if they are not shown separately in the income statement. Only if they are not shown separately in the income statement. Only if they are not shown separately in the income statement. Please stop. Please stop. Or you can put a comma. Only if they are not shown separately in the income statement. Comma. Otherwise, if they are shown separately, if they are shown separately in the income statement, if they are shown separately in the income statement, then do not use them. Do not use them in the expense account. Then do not use them in the expense account. Do not use them in the expense account. Do not use them in the expense account. Good. Do not use them in the expense account. Okay. I've not given the reason why we are using them. Why we have just given a general statement. Don't use, use. I hope you know it's because they are not affecting what I'm adjusting or they're affecting what I'm adjusting. That's the reasoning. But we have not put down the reason. We have just said don't use them or use them. That's more important. The reason is whether they are affecting my admin or distribution. That's what the reason. Okay. So today I want to stop there. Next time we shall still develop the topic and now do a question. Next time we shall do a small development. We shall develop the topic slightly. There is something small remaining before we do a question. Otherwise I would still go back to appeal. Tell your friends. I'll still go back and appeal now again. Please tell your friends or anyone who is watching this and you would want to join our online classes. Tell them, or you know, that we have online classes, either live classes or pre-recorded videos for the following subjects. We have said 1, advanced financial reporting of the advanced level. 2, financial reporting of the intermediate level. 3, financial management of the intermediate level. 4, financial accounting of the foundation level, and the one of ATD1 and ATD2. We have also said if you are not able to join all the classes, in case you miss some, don't panic. Just know that you can still be able to watch the video of the classes that you missed at your own free time. Alternatively, we have said if you are not able to join the live class, you can still buy the pre-recorded videos where you can watch the videos at your own free time, at your own pace. Whenever you have a question, you call anytime. Then I've said you can reach me on this number 0722 658875. Then I said if you're using the country code, it's 254 722 658875. Then I've also requested and said, for those of you who are watching me through YouTube, please click that subscription button down there. You can even do this as you're watching. Click that subscription button to subscribe to our YouTube channel so that whenever we post new videos into the YouTube, you will be notified of the posting. We have said our YouTube channel is called CPA Joseph Njuguna. You go there, you will find our page. Then I've said, click that like button for those who are watching through YouTube. Click that like button to like the video. I hope by now, at least you have understood something in what we have discussed today. And the emphasis today was, how do you prepare a cash flow statement using the direct method? I've talked about how do we determine the cash received from customers, how do we determine the cash paid to suppliers. Those two, I said, they are not critical. The only thing to remember in sales is total sales, not credit sales. 2, for creditors, I said remember to use total purchases, not cash purchase, not credit purchases, total purchases. Then I've mentioned how do we determine the cash paid for services rendered. That was the critical item on how to prepare the expense account. Good. So allow me to stop there. Click that like button. I hope you have liked what we have said today. Click that like button. So unless somebody has a comment, you can comment. Let me see somebody who has a comment or a question.